Okay, so now we're going to cover everything that you need to know about expansion lines. These are the white lines on the chart. What we're going to cover are how are they formed, what do they represent, and why are they important for understanding markets. So let's get into the lesson. So how are expansion lines formed? Expansion lines appear when our algorithms confirm price has left a contraction zone. So it's left the first phase of the market and it's signaling the expansion phase of the market. That's why we call them expansion lines, because they're a signal to that. The lines will appear either immediately after price exceeds the high or low of the current box. So when it breaks out of the high or low of the box, you'll get an expansion line. Or it can happen on a box confirming candle that is already broken out. That is that one candle lag that happens. It's very rare, but it can happen. If price confirms a box and breaks out of it on the same candle, then you will get a box appear and an expansion line will have already appeared as well on that candle. This is something it's very, very rare that it happens, but it has to happen this way so that we don't get any kind of repainting. So there's definitely a benefit to keeping it that way. Expansion lines can also appear by themselves without an attached box. These will appear when the ATS algorithm has identified a relevant expansion point, even though the contraction formula was not met immediately before. This happens due to the nature of how different time frame specific candles open and close. So, and these expansion lines mean the same thing as ones associated with a previous box. This is the sophistication of the ATS algorithm. These expansion lines, they don't have the box before them, but they are a relevant expansion point. So you want to use them just as you would use a line that's coming out of a box. It means the same thing. So take it as very relevant information. So what do expansion lines represent? Expansion lines are the dividing point between market taker buying and selling pressure relevant to the time frame being viewed. When we talk about market takers, these are not market makers. Market takers do not have a responsibility to make a market for someone else. They're just getting in. They need the market makers to make them a market so they can speculate on price at will. So this is going to be the dividing point between where they want to buy and where they want to sell as a general market. The expansion lines also represent the balancing point for the market maker's book of business. Like we talked about in the boxes in the last lesson, that expansion line is going to be drawn forward and represent that balancing point, which we will also sometimes refer to as average price in some of our other trainings. The expansion lines serve as a leading indicator of volatility entering the market. This means the markets are about to move. Get ready. Again, we covered this in the All About the Boxes lesson. When you see that white expansion line pop up, that's a volatility signal. That means that on that time frame, relevant to that time frame, markets are getting ready to move away from that average price or that expansion level. So let's look at a typical example of this all playing out. So in this illustration, we have the market that's ran up. It's formed a top. So we see some increased selling pressures coming into the market. But meanwhile, it is still in an uptrend. So you still have buying pressure for people following the current trend, expecting it to break long. When this evens out, you're going to get a situation in the market where it becomes that market maker balance point, that place where they can do two-way business very easily and collect a lot of spread commission. Eventually, it's going to break from this balance point, which would be our expansion phase. Then that's where in this scenario, market is coming down. You have now the market's actually moving down. Traders can see that happening. So the selling pressure is going to start to outweigh the buying pressure because of that confirmation. Since the market maker is facilitating all that business, their book is going to get heavy with buy positions. If they choose to, they can balance this out by driving the market up through average price. Now it reverses. Now because we're above that pivot point, now the market maker's book starts getting heavy with sell positions, which can be by design. They could want this to happen. And then eventually they can drive it back down, and you see eventually they'll hedge their positions and they'll let the market fall naturally. They control those floodgates. As we get through the average price, then it goes into the real trending move down to lower prices in this illustration. But you can see how that expansion level, how the market behaves around that sensitive price level. That's very relevant information when we're forming our analysis, and that's why the expansion lines are very important to understand. So in conclusion, why are expansion lines important for us as ATS traders? They provide exact price levels that make up the underlying framework of real buying and selling dynamics. They give ATS traders specific prices where current market sentiment will change. Again, going back to the basics, if you're above expansion, you're going to have increased buying demand. If you're below expansion, you're going to have increased selling demand. That's that pivot point, that point of control that gives us that framework. They provide ATS traders a solid basis for decision making and strategy execution. They are not controlled by specific indicator settings and yet give the same predictable information every single time. This is so important for creating the underlying stable platform that you're learning to trade on. This is so important because it's the same every day. It doesn't make it easy, but the fact that there's no settings to change gives you the same screen to look at, the same market behavior to classify, which will get you to be able to feel price and understand where it's headed over time. The more time you spend with this chart mapping system, the more you're going to be able to feel around the framework that the markets create using the ATS chart map. So this makes them a key factor in providing evidence against random walk theory, which makes them a building block that shouldn't be overlooked when constructing a successful market approach. By understanding the expansion lines in the ATS chart mapping system, you'll quickly understand that there's no basis for random walk theory in the markets. The markets are not random, people do not all act rationally in the market, and the markets do trend, which gives us an edge. So by using the expansion levels as the overall structure, looking at how they act together, that provides you with that solid framework, and when combined with an overall trend, it gives you a pretty lethal approach to be able to understand the inner workings of the trend and the sensitive price levels that will either propel the trend or cause the trend to fall apart, depending on how price interacts with those levels. Okay, so that does it for everything that you need to know about expansion lines. In our next lesson, we're going to be talking about everything that you need to know about liquidity lines. So go ahead and go to the next lesson, and we'll talk about that.